This video is 5 quick things we can learn from the tax report. The first thing is not even really a tax planning thing, it's a financial planning thing, and that is we can back solve for what your client spent in the past year. What we have to do is we take total income last year, and there is a total income line in the tax report here. Just remember though that that's the total income as reported on the tax return. So we're going to have to add back to that any 401k, 403b, any salary deferrals. We're going to have to add back any tax-free interest income. We're also going to have to add back the portion of Social Security that was not taxable, because the total income line on the tax return excludes all 3 of those things. But once we have total income, and then once we have total tax, we're getting very close to the amount spent. All that's left is subtracting out any aggregate contributions to the portfolio over the course of the year, or we have to bring in any distributions made from the portfolio during the year. But with those 3 variables, total income, total tax, and then contributions, distributions to or from the portfolio, what's left is whatever the client spent. And so that's a way to back solve for the amount spent on the year. The next thing isn't necessarily a planning opportunity, but it is an engagement opportunity with the client. In this case, I mocked up a tax situation where the client had a low enough overall total taxable income that a portion of their capital gains were not taxed at all. So in this case, this client had low enough taxable income that their total taxable income was lower than this $78,000 threshold to make capital gains taxable. So a decent portion of their qualified income was tax-free. Once there was enough capital gains and qualified dividends to get them over this limit, then it was taxed at 15%. I'm highlighting this only because this is a great way to show a client, if this is something you did for them in the previous year, look at what I did. I was able to harvest gains for you, and you didn't have to pay any tax on it at all. This is a great example of something that one of the advisors using Holistiplan suggested we add to the report. And I'm glad they suggested it, because I think this is useful information to share with the client when you're able to provide that kind of value. $63,000 in this case of essentially tax-free income, harvested gains, is a pretty big deal. Still looking at capital gains here, I made a really simple situation where the client had capital losses. So in this case, I put in $30,000 of capital losses. The report here shows us that we have $27,000 of carried forward capital loss. So as we enter the end of the year, that's useful information when it comes to coming up with a gain harvesting strategy. We have right here on the report, what is the carry forward loss? In this case, $27,000. Finally, on capital gains, I put together an example here where the short-term capital gains far outweigh the long-term capital gains. And that's just an example of, it could be just circumstance, or there could be a behavior thing or a process thing that might need to change in case there was a potential for any of these short-term gains to have become long-term had we just waited a bit longer or followed a more distinct process on making sure that we harvested gains when they were long-term with better tax treatment. But the report highlights that breakout right there. So it's a good at-a-glance way of just seeing, hey, maybe something's off here, maybe worth further research. Next, let's look at charity in Schedule A. This particular client, they contributed $40,000 to charity. They itemized on their tax return. And because they're both over the age 65, the system knows that their standard deduction would have been $27,000, but they itemized. Now, we as advisors know that there are things we can do with charity, especially in a case here where there's no other or small other itemized deductions. There's a real opportunity potentially to group charity into a donor advised fund, into alternating years, for example. So that's something I'm going to watch for. Another thing I'll watch for, and the report will highlight this, is if the client's over age 70 and a half, if I've supplied a birth date for the client, Notice it says here, James is over the age of 70 and a half and thus eligible to make a QCD, qualified charitable distribution, from an IRA. And so that's another example of where instead of a donor advised fund, potentially because the client is old enough, if they have the assets in IRA, that's another thing they could explore, is a qualified charitable distribution. And that allows them then to take that standard deduction so they don't essentially lose that $27,000 deduction. Next, we can see here that the observations section says, given that you are in a lower marginal tax bracket, you may consider converting eligible retirement accounts to Roth. Let's take a look up here. This particular client is in the 12% bracket. They've got about, it looks like $9,000 of room in that 12% bracket. And so depending on the circumstances, if this is an unusually low tax year for them and we expect something similar to happen in the coming year, that's a great opportunity for a Roth conversion, because we can essentially fill up that 12% bracket with a Roth conversion and still keep them out of this 22% bracket. And there's some tools in the scenario analysis screens to do that. But it's just a great at a glance thing. Let's take a look. Does this look lower than it normally should be? This marginal tax bracket section. Do I expect the same thing to happen next year? If so, we should definitely consider Roth conversion, bringing income forward into the year. Finally, let's look at Schedule B here. It's not necessarily a planning opportunity, but it's a good way to just make sure that your client's assets are the assets you think they have. I have certainly had cases in my own professional life as a planner where there may have been accounts that clients had that I didn't know about, or they chose or forgot to tell me about. But Schedule B, they're not allowed to hide it from the IRS. And so Schedule B is a great place to see, wait a minute, I didn't know my client had this Charles Schwab bank account. That's worth a conversation with them. Either they forgot to tell me about it, in which case we can talk about bringing it into the portfolio, or they purposefully didn't tell me about it, and that's another important conversation to have with the client. In any case, reviewing Schedule B on every tax return year is absolutely worth doing, and it'll show up here in the report whenever there is Schedule B income reported. And that's it. That's 5 quick things we can get out of the tax report. There's a lot more there, but those are 5 things that I think any advisor is going to want to do probably first. And that's going to already uncover some pretty important strategies, some pretty important conversations to have with the client. And that's why we do tax planning, because every year we get this great window into their lives, and it allows us to engage with them in a whole new way.